I would also like to bring the discussion front and center on how it impacts investments. So we have to give President Trump and the administration points for thinking boldly and being imaginative and not being afraid to disrupt things in order to improve things. And so those are the types of characteristics that have given the market an incredible amount of enthusiasm. In fact, if you look at how the market reacted immediately after the election, the market went up and up and up towards the end of the year, pretty much all the way up to inauguration. That's the good part. The hope, the confidence, the idea that we're going to be seeing all kinds of imaginative and bold initiatives that are brought about, the breaking of the deadlock in the Washington Beltway, the cutting through of bureaucracy, the renewing of the 2017 tax cuts that are due to expire at the end of this year, and the markets believe, and I also believe, there's a high likelihood that those will be extended. So a number of tremendously, bullish initiatives are being introduced by the new administration, and that's good. What's not good is that it comes with a lot of uncertainty, a lot of chaos, at least in the short term. Talks about tariffs and exactly what those tariffs will mean, and who will pay for those tariffs, and how they affect international trade flows. Talks about the DOGE, the Department of Governmental Efficiency, with laying off federal workers and cutting the tape. That's what's going on with the administration. We also have things such as the deficit, the uncertainties associated with the federal deficit, right? We have roughly a $2 trillion deficit, and if we push through the tax cuts and we impose tariffs, that will have some of a tug of war effect. One thing, reducing the revenues, thereby increasing the deficit, and the other, increasing revenues, thereby reducing the deficit. So how all this will play out remains largely uncertain. Now, we're still just 6 weeks into the administration, so hopefully we'll be able to come back a year from now and be able to look back at a year and 6 weeks and see how things have played out since that time. My gut tells me as an investor that we are going to see some very positive initiatives coming from the administration. However, it's going to be a rocky ride. There's going to be a lot of headlines, a lot of uncertainty, and a decent amount of chaos, which is why we love to work with Doug and Garrett and Brice with the Wealth Guardians, because they do such a good job analyzing the market environment and the economic environment and putting in place plans, financial plans that are appropriate for each one of you, so that you have a good, solid plan in place to be able to navigate the uncertainty and not be changing your investment profile or your investment holdings based on whatever the headlines are saying. So I guess the short answer is buckle up, and I'm hoping for a good ride.
So it kind of taking that context a little farther, when you look at, and anybody can do this on your phone, when you look at a chart of the Dow Jones or S&P and you zoom out to a 10-year chart, it looks like it's kind of ski slalom going straight up, right? When you zoom in and you go down to, 5 years, 2 years, 1 year, weeks, days, if you want to look at days, it looks very choppy, it looks very violent. So are you saying that, and maybe this is an opinion because nobody can totally predict, but
my glasses can.
Well, that's true. You're not helping your career out here, man, I'm telling you. Is your opinion that the long-term effects of some of this stuff is more bullish, but the short term is, hey, we could see some violent waters here in the short term, meaning, within a year or less period?
Yeah, good question. Let's unpack that, because I wouldn't characterize it that way.
Okay.
Here's how I would characterize it. If we look at the big, financial services firms, the big strategists, the biggest Wall Street analyst groups out there, each one of them publishes their projections for the market for the coming year, and they do that at the beginning of the year. And if you take the top 20 the top 20 of all of those big Wall Street firms, and you look at their predictions for the S&P 500 returns 2025, without a doubt, across the board, unanimously, they are bullish. The ones that are most bullish are predicting over 20% returns. The ones that are most bearish, you know, the flies in the punch bowl, those that are, you know, the negative Nellies that you never want to invite to the party, they themselves are predicting 6 to 10% returns, only 6 to 10% returns, right? So let's take a step back here. The markets have just had 2 unbelievable years of that ski slope growth, right? If you had invested in S&P 500, it would be a very risky investment on its own. I don't encourage this unless you are a cowboy with respect to your risk tolerance. But if you had invested in the S&P 500 over the last 24 months leading up to the beginning of this year, your investment would have gone up almost 50% in 24 months. Now, I want to be clear. If there are any people here whose accounts actually went up by 50% over the last 2 years, I want you to take a step back and ask yourselves if you have the right amount of diversification in your portfolio. I would argue, without knowing anything about your individual circumstances, the answer is probably no. You're probably very concentrated in very risky assets, which can go up 50% in 2 years or can go down 50% in 2 years. What's more likely is that you have more well-diversified portfolios, but you've done well in those portfolios over the last couple of years. So why am I saying this about 50% and the Wall Street firms, et cetera? I'm saying this because we need to manage our expectations, especially in the short term. I think it would be reckless of us to get up on a stage and say, you can expect those very, very bullish returns. Rather, I believe we should temper our expectations in the short term, and we should bring them down to something along something along the lines of the long-term average. Long-term average return for the S&P 500 is about 8%. Long-term average for the aggregate bond index is about 4%. If you've got a 50-50 portfolio, 6% is probably in the ballpark. 6%, by the way, is the most bearish of the bears in that group that I mentioned earlier, right? So I'm saying expect less this year than what the talking heads on TV are saying. Now, what's important, Joe, is that that's just for this year. You also asked about longer term. Honestly, the longer term, I'll be perfectly honest. We've got sophisticated analysts on our team. We do a lot of research. We're plugged into all the best research, and we even have AI that's helping us to see into the future. And beyond this year, it's very hard to tell where the markets will go. And one of the reasons it's hard to tell where the markets will go is we don't know how much of the disruption that we are seeing this year and will likely continue seeing throughout this year, how much of that disruption is going to end up being positive when the dust settles, and how much of it will end up being chaotic, causing for perhaps more chaos that builds on top of that. So again, if you were to ask me, what's the date today? This is the 27th. If you were to ask me, in the month of March, what do you predict that the rainfall in Clemens, North Carolina is going to be? Now, I have different ways to answer that. I could say, well, let's see, we've had above average rainfall this year, so I believe next month we're going to have above average rainfall. Or I could say, well, we've had above average rainfall this year so far, so we're due for a correction and we'll have below average rainfall next month. That's one way to answer it. A better way to answer the question, I believe, is to take a step back and look at the long-term average rainfall in Clemens, North Carolina in the month of March, and that's my answer to what my prediction will be. So, Joe, when you ask me what the prediction will be for this year, I say let's look at the long-term averages, and those are much better anchored than some of the material that we're seeing published by the big Wall Street firms.
Yeah, and that makes a lot of sense. Everything that you hear this industry talk about, it says the market is going to do this. And even my question was, what do you think the market's going to do? And what is the market? right? The market is what, an index, S&P 500 or Dow Jones. But what does that matter to you if you didn't buy the S&P only? The market is your market, your individual market. And so it's very important, I think, as you're sort of illuminating this idea of, get specific when you look at the weather in Clemens. That's where you live. Get specific with your portfolio. What are some of the things that you have going on in your portfolio? And that's why it's, with Doug and the team to navigate some of those. It's not about what the market will do. And I ask this question, who knows I'm going to ask the question. He gets answered the question all the time. What do you think the market's going to do? Right? Every CIO in the country gets asked the question. They can't live or die on, I'm going to bet everything on this. That's why they're CIOs. They don't bet. It's more just.
I'm sorry to interrupt you. Let's play a game with my glasses, shall we? I haven't done this, folks. I haven't done this. Let's find out what AI says, shall we? Hey, Meta, what's your prediction for the S&P 500 total return this year?
Sorry, I can't predict the future or provide investment advice, but I can give you current information about the S&P 500.
Nah, never mind. Thank you, Meta.
See, she's not comfortable playing the flag either. Right, so.
Her lawyers told her not to answer.
So Tony's still got a job. That's good. Tony's still employed. No, I think it's important that you think, we get wrapped up in the talking heads of the news and the radio. And what's the market going to do? And the market's up, the market's down. You pull out your iPhone, it's red or it's green. But did you invest in that? Is that your whole plan? No. You're with a great group that does holistic wealth planning. They think about the whole thing, including all of this short-term chop, if you will, and maybe the long-term prospects of keeping you exposed to some reasonable, returns that Tony is talking about. So, moving on, some things that affect us personally. I take my family out to breakfast. It's pancakes, it's eggs, it's coffee, it's $50. I'm like, what happened, right? Is it, that's, where do you go to breakfast? I want to know.
Can I come to breakfast with you? It sounds like a dang good breakfast.
I'm trying to find a way to maneuver, but, everything's expensive, guys. Like, we know that, right? Our whole lives got more expensive. Every single thing we do, it's inflation, it's a hidden tax on everything we have and do, right? We all know that. Inflation and interest rates, money moving, right? It impacts how much wealth we're actually left with to then utilize for our future. How do you see, as inflation has had just, a record run here, do you think that continues in terms of inflation? Do you see the interest rate markets? I know the Fed has talked about cutting down rates multiple times, and it seems like they're not budging as much as maybe we would hope in certain circumstances. How do you see those two factors moving? Because those I feel like really impact our actual wallet, our day-to-day spending power.
Sure. Yeah, great question. So inflation really hit a generational high back in 2022. There are various measures of inflation, but regardless of which measure we use, inflation got very high. We had COVID, and we had a lot of stimulus injected into the economy as a response to that, multiple rounds of stimulus. We also had supply chain disruptions, which restricted some of the supply of goods and then caused the prices of those goods to go up. We also had, unfortunately, the war in Ukraine broke out, and that put a premium on oil and energy prices, which are also considered within the gauges of inflation. So we had this massive spike in inflation. It was higher than at any time it had been over the prior 40 years. And then good news is in late 2023 and then 2024, inflation has been coming down. So we have largely brought inflation back to a range that is consistent with the long-term average. We talked about long-term average rainfall, 2 to 3% inflation, roughly in line with the long-term average. The problem is, I don't think we're there yet in terms of being able to do a victory lap and say that we have the inflation problem contained. In fact, I believe that the largest risk for investors in 2025 is the risk of inflation reasserting itself. Why do I say that? Well, it goes back to the earlier question about what's going on in Washington and the the initiatives that are coming about. Many of these initiatives are tremendously bullish for the economy. Things like tax cuts, deregulation, etc. But let's keep in mind that when we have things that are bullish for the economy, that causes people to spend, and all else equal, more spending with the same supply drives prices up. So that's the negative side of economic growth. If you have economic growth, it also pushes prices up. By the way, let me ask you a question. Raise your hand if you think that inflation is good. Oh, it depends. I like it. I like it. Let's do this. I know we're going to have plenty of time for Q&A, but I'd like to ask a question to the gentleman who said it depends. It depends on what? Oh, Garrett, what rate? Okay. By the way, we didn't rehearse this. This wasn't pre-planned. What rate? That's actually, I'm really glad you said that because I feel the same way. Raise your hand if you have some investments in the stock market. Any stock investors in the room? How many people, keep your hand up, how many people would like to see the price of your investments go up? I didn't see any hands go down. That's inflation, ladies and gentlemen. So it depends. There's some inflation that's good. How many people are homeowners? Keep your hand up if you want your home price, the value of your property, to go up. Right, 2 hands up from this gentleman. Exactly. That's inflation, and that's good inflation. We want prices to rise. There is inflation. There's a natural state of inflation in our economy. That's why we have dollar stores now, and we no longer have 5 and dimes, right? Think about it. Right? Remember the good old days when you could buy a Hershey's bar for a nickel and a Batman comic for a dime, we don't have those anymore. Why? Because of inflation. Now, the right amount of inflation is good. Hyperinflation is not good. Out of control inflation is not good. And we had hyperinflation and out of control inflation for a couple of years in 2022 and 2023. And even though we've done a good job bringing it back down to a more or less normal range, I don't think we're out of the woods yet. Why do I say that? So we've got these bullish activities from the administration that could cause prices to go up in a good way. But we also have other initiatives that, if they pass, are inflationary in nature. First one is tariffs. Very controversial topic. I'll put my cards on the table and say, I'm not a fan of tariffs. They didn't work in the 19th century. They didn't work in the 20th century. They're not going to work in the 21st century if the goal of tariffs is to reduce a trade deficit with our trading partners. And the reason I don't think that they're going to work is because when we impose tariffs, it causes our currency to rise, thereby making the imports cheaper, which is what we want, but making our exports more expensive. Meaning we have the same deficit, even though we raised tariffs and the currency rose. And by the way, that also tends to invite retaliation from our trading partners, thereby leaving us in a situation where we have the same deficit but lower amount of overall trading, which reduces competitiveness and it reduces what I believe is healthy, that is a competitive cooperation among our trading partners. I don't want to go too far down a rabbit hole here, but I think it's important to unpack that tariff concept. I think you may have a tariff question in your back pocket, but I'm gonna answer it. So the reason it's important to unpack the tariff idea is because, well, it's in the headlines, and frankly, it's confusing to a lot of people. And I'll admit it, I get confused about some of the discussions that are going on as well. What's important to keep in mind with tariffs is there is a government entity that steps in between the free flow of capital. Now, I am a free-flowing capitalist, right? I am somebody that really believes that the markets are the most efficient way to determine pricing. Let market participants figure it out. Buyers and sellers, you get lots of them together, and sellers will sell for as much as they can get away with, and buyers will buy for as little as they can get away with, and they'll find equilibrium and come somewhere in between. And when we introduce artificial filters between buyers and sellers, that creates distortions in the market. And I believe that if we end up going down the road of applying tariffs in a heavy-handed way, this will result in distortions in various pockets of the economy, leading to certain bubbles in the pockets of the economy, leading to inflation in certain pockets of the economy, and these will eventually have to be reconciled. Now, there is one situation in which tariffs can actually be very effective, and that is when they're used as a bargaining tool to get our trading partners to the negotiating table. And I actually believe, I don't have any better insight into the president's mind better than anybody else, but I really believe that despite all the bluster and all the tough talk about we're going to do this and we're going to do that, the main rationale for the tariff discussions is to bring about negotiations. It's the art of the deal. So I believe that there's a lot of talk of a lot of tariffs, but I also believe that we're not going to see nearly as much actually implemented as the talk would have us believe. By the way, folks, if you've been paying attention to the score of the tariffs discussion, there was supposed to be 10% tariffs on Canada, 10% tariffs on Mexico. There was originally going to be 25 to 60% tariffs on China, tariffs on steel and aluminum, tariffs on cars, tariffs on chips, healthcare. We could go down the list. What all has been implemented? 10% tariff on China. That's it, right? So unless you're really paying attention, it seems like tariffs are this ginormous topic, and it is in terms of occupying the headlines. But what has actually been implemented is actually quite modest. So what was the question?
We were talking about
inflation
and interest rates.
I was gonna ask my glasses to pull me back on track. So I believe, so let me answer your question finally with two succinct statements. I believe that the largest risk for investors in 2025 is the risk that inflation rears its ugly head again. And the second statement is, if it does, interest rates are not going to be falling. They're likely going to be rising. And the way that they would fall is if we go into more economic uncertainty.
I don't like any of those things.
I don't like it either.
Okay. All right. How does all this tie into the current state of the overall state of the economy in terms of housing, in terms of jobs? I mean, some of this stuff I understand what you're saying in terms of the tariffs is, sometimes it is a bargaining chip, and we see a lot of that stuff going on, maybe influence different players to come to the table. But how does that? Where do you see like the jobs numbers? Sometimes it feels like they have been manipulated in the past and maybe sort of skewed a certain way. People got laid off, then they got their job back. Is that really a job increase? So help us clear through the noise of all that.
Yeah.
Like, where do you see things going in terms of jobs, housing, the overall economic fortitude of the country?
Yeah.
And then how does that impact us as individual investors?
Yeah, sure. Great questions. So let's take a step back and look at the overall economy. The U.S. economy, our GDP, 2/3 of that comes from the consumer. The consumer has the two biggest issues for the consumer. Everyone here is a consumer. I'm a consumer too. We just consume this wonderful meal and we'll continue consuming other things. The two biggest issues for the consumer are the jobs market and the housing market, right? Houses they tend to be the biggest asset within any household. And jobs, I like to say jobs are the wind in the sails of the economy. When we have a strong jobs market, the economy will sail. When we have a weak jobs market, the economy will stagnate. This is largely a good news situation. So U.S. economy is roughly 1/4 of the global economy. And the U.S. consumer is roughly 2/3 of the U.S. economy, meaning the U.S. consumer is actually 18 to 20%, let's call it 1/5 of the global economy. So the U.S. consumer is extremely important. Good news for the U.S. consumer is we've got a very strong jobs market, right? We are not quite at the multi-decade low unemployment rate, but we're still very close to that. 4%, 4.1%. In previous eras, 4 or 4.1% would have been categorized as full employment. There's always going to be a small amount of unemployment just because of frictions in the market, part-time workers, people leaving one job, getting another job 6 months later. So there's always going to be a small amount of unemployment. But the jobs market is still very, very strong, which is one of the reasons why I continue to be bullish about the economy in general, barring any major disruptions. So I think that as we go throughout the year, we're going to see the unemployment rate rise somewhat, but it's coming off a very low base. And I believe that if we come back next year at this time, we will see an unemployment rate that is a little above where it is now, but still generally very strong. At least I'm hoping that's the case. You know, if I ask my medical glasses, she won't answer because there is uncertainty about this. But I still think even if we have some unemployment increases, we're still going to be in a strong jobs market a year from now. That's the good news. The not so good news is because I'm seeing more upward pressure on inflation and interest rates than I or most people would like, that is likely to keep interest rates high or in the range where they currently are. And therefore, all of those people that have been sitting on the sidelines waiting for mortgage rates to come down before they jump in and buy a house, or see mortgage rates come down to see the property value of the homes they own rise, I wouldn't be holding my breath for that. I wouldn't be surprised if a year from now, the 30-year mortgage rate continues to hover around the same rate where we are now, give or take, half a percentage point in either direction. So a succinct answer to your question, Joe, is jobs are strong, and I expect them to weaken only marginally, but stay strong. The housing market's pretty expensive, mortgage rates are pretty high, and I don't expect much movement there for the rest of the year.
Okay. So I think before we get into some Q&A, can you just summarize? We touched on, 5 different points, Trump 2.0, AI, housing, and
Jobs.
Jobs, thank you. Interest rates and inflation.
Will the markets continue?
Will the markets continue? Yep. So help us just, if we were to walk out of here just with the quick, 2-minute package of like, well, what does this mean going forward for us?
Yep, this is a year of headlines, chaos, uncertainty, but behind all of that, I expect generally favorable conditions in the market. And it's important for investors to work with your advisor, have a plan in place, and not be reactive. The reason to have that plan in place is you shouldn't be monkeying with your investments based on what the headlines say. The headlines are increasingly optimized to excite you or to scare you or to get you to click on things or to act. Resist those urges when it comes to your investments. Work with the wealth guardians to ensure you've got the right plan in place to get you to your economic goal using means that are comfortable to you all. That's how I would summarize.
Love it. Awesome. Ready to open up for questions?
Let's do it. Let's have some questions. This gentleman who had 2 hands in the air earlier. Yes, sir.
Is there a precedent that the stock market is going to level off after the first 2 months of the exuberation of the new administration?
Oh, so I'm told I need to repeat the question. The question is, do I believe that the stock market's going to level off after the first 2 months of the new administration? Before I answer, I want to tell you what Brice Payne told me. He said, last year when you were on this stage, I said, that despite a really strong first couple of months of the year, I believe I'm still bullish on the market for the rest of the year, but not at the same pace. Brice, was that right? Did it end up being right? All right. Thank you. So this year, same situation. However, it's important what happened. From November to the beginning of January, we had a tremendous run up in the stock market. And if you've been paying attention over the last 3 weeks, it's largely come back down. In fact, I haven't looked at the total returns for the S&P 500 year to date today, but I believe we're at about 1%. We were up close to 5% about 3 weeks ago, and we've lost about 4%. So I don't believe that it is fair to characterize